AI is not one homogenous investment. So there are different parts of the value chain. There are semiconductor companies, memory chip companies, but there's also cloud infrastructure, software platforms, and ultimately the companies which are applying AI within their existing businesses. So I think we're seeing companies at different stages of maturity with different expectations priced in.
Hello, you're watching Proactive. I'm joined by HANetf product specialist Vincent Chung. Vincent, very good to speak with you. We're in the middle of second quarter earnings season in the US, and there's been a big focus on AI-related companies. Are investors starting to separate the winners from the losers in AI?
Yeah, definitely. I think we see that in what happened with the likes of SK Hynix falling by 15% last week. But on the other hand, Microsoft and Amazon conversely increasing by 15%. So I think we're definitely seeing a sort of a tale of two stories. So on the one hand, we see names which have probably experienced a little bit of irrational exuberance, have been pumped up by some of the retail trades which have gone on, obviously not helped by the IPO which occurred also on the US stock market vis-a-vis SK Hynix. And then I think on the other hand, we're seeing companies which are being rewarded due to they're actually monetizing the large amounts of capex which they've poured into various aspects of their business.
What was different about Microsoft and Amazon?
What was really different is that they have actually managed to monetize their cloud division operations. And what I mean by that is Azure, so Microsoft's Azure saw a 43% increase in year-on-year revenue, and Amazon similarly saw an increase of 37%. With respect to Microsoft, they additionally saw their total paid users for Copilot reaching over 30 million. That their share price increase actually represented a record increase in any one stock in one single session. So it represented an increase in market cap of 450 billion US dollars. So I think we're definitely seeing how investors are now being more selective when it comes to their AI plays, and they're recognizing that there are various different parts of the AI value chain, and that it's not a broad beta play, but it needs to be more nuanced.
Why does greater dispersion strengthen the case for active stock selection?
I think that's a great question. And the reason is because, as I was alluding to before, AI is not one homogenous investment. So there are different parts of the value chain. There are semiconductor companies, memory chip companies, but there's also cloud infrastructure, software platforms, and ultimately the companies which are applying AI within their existing businesses. So I think we're seeing companies at different stages of maturity with different expectations priced in. And obviously, I think that creates real opportunities for active managers to exploit those nuances.
Does this mean investors need a longer term view?
The recent volatility reinforces the importance of long-termism versus short-termism. So, I think there's a real danger of getting caught up in the short-term AI momentum trades that we see. And I think, the bigger returns may actually come from actually holding stocks. So for example, with Microsoft and Amazon, these have been held by our partners at Lloyd Capital for 6 and 9 years respectively. And so the value comes from holding these companies, letting them compound, and then actually effectively letting the business thrive, as opposed to constantly trading in and out of stocks on tactical basis. So definitely a longer term view is needed. And I think I'll just conclude this by just saying that I think there are definitely certain parallels to be drawn with what occurred with the dot-com bubble, where we saw a lot of companies that no longer exist to this day. So similarly, I think we'll see a similar thing with AI companies, the likes of which we hear in the news, but probably in 50 years' time, they'll no longer exist.
Vincent, thank you very much for your insights. Great speaking with you today.
Thank you very much, Stephen.
It's Vincent Chung, product specialist at HANetf.